If you're wondering why so many farmers are stressed about their finances right now, the truth is, they just can't catch a break. It's not only that corn prices have dropped below the break-even point for most growers. The real gut punch is that input costs are still sky high. For decades, the United States held the crown as the world's top corn exporter, but now, that title has slipped away. China had already paused orders for United States soybeans and corn before the recent tariff spike, delivering a major blow to American agriculture. To make matters worse, the USDA has scrapped local food programs that supported Humboldt schools, tribal communities, seniors, and food banks, programs that also gave a lifeline to ranchers and farmers. Right now, corn prices have crashed to just $3.50 per bushel, triggering a full-scale crisis across the United States Corn Belt. Over 2 million tons of corn were sent right back to New Orleans by international buyers, turning multi-million-dollar contracts into worthless paperwork overnight. From Iowa to Indiana, combines sit untouched because harvesting would actually mean losing more money. Cracked kernels are left in the fields, soaking under the rain, like a massive grain dump no one wants. While American farmers face fresh debts and crushed morale, Canada has quietly planted its flag on a new multi-billion-dollar grain supply deal, inking agreements with Japan, South Korea, and Europe. In silence, they've staged a takeover at the world's dinner tables. So how did United States corn collapse so fast in early 2025? While Ottawa calmly closes deals that funnel millions into Canadian pockets, today's video will break down every crack in America's corn economy and explain how Canada managed to rise as the new grain king. Right now, United States tariffs are effectively eating away at corn exports while the grain is still stuck on barges. After Washington slapped fees of up to $1.5 million per trip on China-built cargo ships, Gulf of Mexico shipping costs soared by about 25%. That's added nearly $930 million per year to United States export expenses. Trans-Pacific container rates haven't been kind either. In just the first 2 months of 2025, XA Asia shipping rates doubled to nearly $5,000 per FEU, far above post-COVID norms. But there's a second, sharper cut pesticide residue testing fees. On March 14, 2025, the Federal Grain Inspection Service rolled out Directive 9180.40, raising the multi-residue export test fee from $57 to $81 per sample. That's a 40% jump in just one crop season. Now every United States corn shipment needs this costly certificate or risks being turned back halfway across the ocean. Expenses are skyrocketing, yet the grain just won't move. According to the February Grain Transportation Report, barge traffic on the Mississippi River is down 16% compared to the 5-year average. In New Orleans, port berths are jammed with ships waiting for empty containers and new security paperwork. More than 180 vessels are stuck at anchor. Meanwhile, Iowa and Indiana corn sits in fields, getting soaked and spoiled. Farmers lose an extra 27 cents per bushel just waiting for a ship to load. At the same time, global import standards are changing fast. Buyers now demand clean, green, and blockchain-traced grains. In February 2025, Mexico officially banned GMO corn, shifting to pure grain certified with low-carbon labels. Asian and European feed mills quickly followed suit, copying these requirements into their contracts. With 92% of United States corn acreage being GMO, America was effectively blacklisted. Canada, however, had a secret weapon, its Prairie Trace blockchain system, which tracks every grain lot from field to shipment. That helped Canada scoop up billion-dollar deals with Japan, South Korea, and the European Union almost overnight. The results were immediate. Spot corn prices across the Midwest fell to $3.45 per bushel, the lowest since 2016. Meanwhile, Canadian corn held steady at $4.20, boosted by its carbon-free premium. Global traders didn't hesitate. United States corn costs more, takes longer to test, and fails the new non-GMO rules. For buyers, switching to Canadian grain was an easy decision. The world's corn trade map is now being rewritten, right at the docks of New Orleans. On one side, there are stacks of torn-up contracts. On the other, Canada's flag flies over top-dollar shipments that fetch 20% more, just for carrying a green label. With logistics and inspection costs still rising, the real question isn't when United States corn will recover, but whether America's corn farmers even have a seat at the global table anymore. Imagine the entire county of Shelby, Iowa, drowning in corn that no one wants to buy. According to Reuters, unsold corn stocks held by U.S. farmers have now hit a 6-year high. The USDA predicts that by the end of September, there will still be 2.5 billion bushels of corn, around 68 million tons, sitting in silos, baking under the sun and rotting in the rain. This week, the cash bid in Cedar Rapids for September corn delivery sits at just $3.74 per bushel. Meanwhile, Iowa's average 2025 harvest costs are already chewing through $165.75 per acre. That painful gap explains why many Midwest farmers are listing their John Deere 660 combines on Craigslist, or picking up night Uber shifts just to stay afloat. Reuters reports some farm households are holding back as much as 90% of their crop, knowing that selling now would only bury them deeper in debt. Over in Indiana, the crisis isn't just about dollars and cents. According to the state's Economic Council, the economy beneath the Corn Belt shrank by 6.1% in the first quarter of 2025, making it the second worst drop in the country. With incomes wiped out, food aid applications are flooding rural areas. The Food Bank of Indiana warns that requests for help are up 50% compared to last year. Meanwhile, a proposed SNAP budget cut threatens to wipe out 133 million meals for families in need. Crossing into Illinois, the chain reaction continues. For the third year in a row, the Illinois-Mississippi waterway faces record low water levels. Barges now have to lighten their loads and run shorter tows, adding $20 per ton to the cost of shipping crops to Gulf ports. Some sailings are delayed up to 15 days. As a result, grain backs up, and farmers face rising interest rates, while land funds swoop in to buy up acreage at bargain prices. In fact, just in April, the Midwest Farmland Deal Index rose another 6.5%, even though the broader real estate market is cooling. Some rural Illinois school districts are now switching to 3-day school weeks with online classes to cut electricity bills, according to the CTE Rural Illinois report. Meanwhile, in Nebraska and Minnesota, sometimes called the underground corn vault, farmers are now being forced to shut off their irrigation systems. A new Little Blue NRD regulation has cut water allocations to just 13 inches per acre per year. As a result, local co-ops have temporarily halted grain purchases to avoid overflowing storage bins. Along Highway 6, grain trucks have practically vanished. Gas stations are closing early, and a diner in Hastings is now shutting off the grill before 6 p.m. because there aren't enough customers. The local newspaper calls this the zombie economy. Businesses still standing, but cash flow is dead. The final hit in this chain reaction comes from the ethanol industry. According to the EIA, Midwest ethanol plants are running at just 87.8% capacity, with 25 plants closed. That's 1.26 billion gallons of production now idled. In Columbus, Nebraska, Valero's plant cut 60% of its night shifts, leaving 120 workers sidelined. The corn demand market keeps shrinking. From overloaded silos in Iowa to stalled barges in Illinois to shut down ethanol pumps in Nebraska, each broken link pushes the crisis further. Corn, the Midwest's golden icon, isn't just losing value. It's suffocating the communities that depend on it. Meanwhile, Canada is quietly pocketing billion-dollar contracts, calmly taking over the premium segment of the market. The real question for Washington isn't when corn prices will bounce back. It's how many towns will become ghost towns before they do. Canada isn't saving U.S. corn. Instead, it's carving out a high-end niche all for itself. And it's doing it so precisely that importers say buying Canadian grain feels like buying a Swiss watch. Every export container from Canada now carries blockchain tracking from seed to terminal, leaving almost no room for counterfeits. A report from Farmit says North American exporters now treat blockchain as the standard for traceability, and Canada leads the way. A network of farmer co-ops in Ontario and Saskatchewan make this possible. But a traceability seal isn't enough. Ottawa requires all exports to meet the 3 no's, no GMOs, no glyphosate, and no carbon emissions above the EU RED II threshold. The 2021 RED II guide forces agriculture suppliers to prove their entire carbon footprint, from field to delivery. Canada is the first North American country with a unified disclosure system for corn, letting shipments clear EU customs 20 days faster than U.S. grain. The payoff is obvious. The June 2025 Market Trends report from Grain Farmers of Ontario shows that old crop basis prices are running $1.30 to $1.87 per bushel above CBOT futures. That's a 22 to 30% premium. Even new crop corn is pulling in an extra $1.49 per bushel, at least 18% over Chicago prices. That explains why Asian feed mills are willing to pay more. They're not just buying kernels, they're buying a green reputation. The biggest boost came in March 2025, when Canada and South Korea signed the Organic Equivalency Arrangement, known as the CSKOEA. According to EDC, this deal opened the floodgates for organic grain exports. Just 3 weeks after the Free Trade Agreement took effect, Ontario co-ops locked in a 5-year supply contract with a major feed mill group. At the same time, Saskatchewan took advantage of a weak Canadian dollar and the US-EU tariff dispute to sell non-GMO corn to Japan and the Netherlands. USDA Ottawa notes that exporters are aggressively diversifying, especially since Washington's 25% SPA duty kicked in. The result? Fall 2025 EU contracts are now priced at an average of 18% over CBOT, according to Rotterdam desk quotes, a price level Midwest farmers can only dream of. Behind the scenes, Ottawa is building a safety net. Through EDC, farmers can now buy single-lot export credit insurance and get up to 50% reimbursement on cold chain logistics costs to maintain their low-carbon certification. These incentives are not a secret. In fact, they're openly promoted on Export Development Canada's official portal, proudly advertised as strategic tools designed to help Canadian companies raise product standards and pass the strictest global quality checks. One major advantage: they reduce the chances of shipments getting rejected at destination ports due to chemical residues or contamination tests. And the results are already showing across North America's transportation lines. The shift is happening in real time. The very same week Canada signed the CSKOEA trade deal, the U.S. Department of Agriculture reported troubling numbers. Only 30 grain ships were loading at the Gulf of Mexico ports. That's a 14% drop compared to the same time last year. Worse still, the data on 10-day advance bookings shows a 17% decline, a clear sign that something has changed in global supply chains. According to Reuters, many U.S. importers are beginning to look north, to Vancouver, because of Canada's smarter logistics. Canada's rail network runs straight into the U.S. Midwest, giving it a unique advantage. When ships from Asia return empty, they can now be loaded with Canadian grain at cheaper backhaul rates. This reduces costs and makes Canadian exports even more competitive. In other words, the grain compass of North America is spinning toward Canada. The flow of capital, the availability of shipping vessels, and long-term trading contracts are all beginning to lean toward the maple leaf. Canada isn't just selling grain, it's selling a new system. From blockchain tracking that ensures full product transparency to double-digit price premiums for meeting eco-standards, Canada is rewriting the rules. In a world where global markets are going green, the country that moves first doesn't just avoid costly returns, it locks in billion-dollar deals. Meanwhile, farmers in Iowa and across the American heartland are being forced to slash prices and swallow heavy losses. And it's not just about corn anymore. As the U.S. grain and corn export system stumbles, the rest of the American agricultural chain is at risk. The collapse could easily extend to soybeans, where 92% of U.S. soybean acreage is GMO-based. This is already becoming a problem because Seed Europe has removed GMO soy from its low-carbon whitelist, limiting market access. From there, the pressure will move to dairy farms. As feed costs increase, partly due to this corn and soy crisis, small and mid-sized farms could face the biggest wave of bankruptcies since the 1980s farm crisis. For many families, it's not just about the price of milk. It's about survival. Beef production will also feel the heat. Cattle raised on GMO corn and feed that's linked to higher carbon emissions will carry a heavier carbon tax. That makes American beef less competitive when compared to Canadian and Australian meat, both of which are tied to net zero carbon goals by 2030. So now, the White House stands at a critical crossroads. There are only two real options left. Option 1, end the era of aggressive protectionism. Lower tariffs on eco-friendly farming equipment, open the door to blockchain-based supply chain tracking, and create carbon emission rules that match those of international trading partners. Yes, this will come with a steep political cost, but it could buy America a seat back at the global bargaining table and restore trust in U.S. agricultural goods. Option 2, keep the trade walls up, Stick to the outdated system of tangled inspections and government subsidies. But that's the same strategy that drove the Rust Belt rail economy over the cliff 30 years ago. Choosing this path risks turning today's grain crisis into a full-blown rural collapse. If Washington refuses to act, Canada will not only grab more market share, it will secure the reputation of being the global leader in safe, sustainable food exports. That's a brand worth billions, tied to dinner plates around the world. Time is running out. Will the U.S. realign its agricultural system in time, or let the rural economy fall even further behind? Drop your thoughts in the comments below, because this decision won't just change the price of corn in your soup, it could reshape the livelihoods of millions of American families.